Lately, the market's been picking up again, and there's starting to be a pretty noticeable difference between renovated and unrenovated projects, making the returns look even better if you were to take on unrenovated projects. Now, we're not very big fans of flipping because it is a lot riskier, especially when the market changes pretty quickly. Plus, when you sell, you have to deal with high fees and taxes. So a smarter move, in our opinion, is to refinance after you upgrade the property and renovate it to cash out. Now, with the cost of borrowing much higher these days, it does make it harder to take on bigger projects, even if the numbers make sense. So in this video, let's talk all about how to practically finance renovations for investment properties in Toronto today. If you're new here, we're all about helping you make better real estate investing choices in Toronto. Don't forget to like and subscribe if you enjoy our content. Now, let's dive in. With high interest rates, it is becoming harder to take on bigger projects, and that's one big reason why there has been a widening spread between renovated homes and projects, which ends up making the returns look even better if you are able to take on projects. Let's break down how the numbers work recently in hot neighborhoods in Toronto. For a renovation project with a purchase price of $1.1 million plus $200,000 of renovations, this totals $1.3 million. And if you compare a renovated property already at the same time on the market, it could be worth $1.5 million. So quick math does tell us that the value add gain here, if you take on a project, would be $200,000. If you're flipping, you're left with one exit strategy and the net returns might still not be worth it. Once you factor in selling fees of $87,000 and $100,000 in income taxes, since flips are taxed as income, not capital gains, there's not much actual gain here. So a better approach here for us is always to hold and refinance, in our opinion. The difference between the initial purchase price and the new value is $400,000. So in this case, you could potentially pull out 80% of that in cash after renovations, which leaves you with a cash out of $320,000. Just keep in mind there's always risk involved here, whether you're flipping or refinancing, especially if the market takes a dip. But if you are leaning towards holding the property and refinancing, you'll have more options even when the market takes a short-term dip. Holding it and renting it out gives you stronger holding power compared to a flip, even if you can't refinance as much as you hoped out after renovations. The key here is having a long-term mindset so you can wait things out and then maximize your gains when the market picks up again. Now let's shift gears a bit and look at the real issue with the high cost of capital these days. Is it really because rates are too high that the numbers don't work? Picture this. You might be looking at an 8% interest rates with a HELOC for 6 months on a $200,000 project. That means you end up paying out $8,000 for a $200,000 value add gain. Clearly, it's still worth it in our opinion. The real issue with the high cost of capital, in our opinion, is that it does make accessing this capital much tougher because of much tougher qualifying rules. But if you can access this capital, the returns are pretty lucrative. To give you some more perspective, here's how our investor clients are funding projects these days. There's always those who have the cash or they might sell some stocks to finance investment projects. Most investors end up refinancing another property if they've got equity built up. And many are opting for conventional refinancing these days as another alternative to fund projects. You are still looking at a pretty decent interest rate of 5.5% for a 3-year fixed rate loan. Now, the other option for financing would be to take on a HELOC. But here's the thing, HELOCs are tied to the prime rate, which means that you are dealing with higher costs, around 8% plus these days. And also, qualifying for it would be a lot stricter, typically maxing out at 65% LTV, which can make getting a HELOC tougher compared to the 80% loan-to-value ratio that you can get with a conventional refinance. The big benefit with HELOCs is the flexibility of repayment. You're only faced with those higher rates during the renovation phase, and then you can refinance the new value with a conventional mortgage once renovations are wrapped up. If you end up with a conventional refinance to fund renovations instead, you might end up actually holding off on refinancing post renovations, since the extra value you're cashing out at that point would only be the value add portion, which isn't as big in this case. There are also a few clients in Toronto who are teaming up to take on investment projects together. It is a way to lighten the load financially for each person, but just remember, trust is everything in these partnerships, and having shared goals is essential to make partnerships and joint ventures work. Next, here are a couple more options that aren't actually practically done with renovations that we take on, but we often get asked about. Construction loans is the first one. Realistically, they only work well for development projects because construction loans are pretty complicated. With construction loans, you would have to meet certain requirements before you can get the money for the next stage of your project, which ends up causing more delays and bumps up your holding costs eventually. Borrowing rates are also pretty high for construction loans, so they're usually not the best choice for these types of smaller renovation projects, in our opinion, for a home. Another thing that people like to ask about are government financing programs. Honestly, there aren't many of these available. One example is the Toronto Garden Suite or Laneway Suites Development Charge Deferral Program. But realistically, DCs on these only apply for homes with more than 4 units in Toronto. And when that happens, this program ends up deferring your development charges for 20 years. And finally, I'll touch on rebates a bit. In terms of rebates, you would still need the cash and capital up front, but you do get reimbursed later on when you're done renovations eventually. The first one that we want to point your attention to is the HST New Rental Rebate. What happens here is that you do have to pay that 13% HST upfront when you're creating new rental housing, and then afterwards, you could potentially receive a portion of it back as a rebate. Now, the rebate amount depends on the fair market value of your new rental unit, and if the value is under $400,000, you can expect around 7 to 8% back as a rebate. Not bad. Now, the second rebate would be the multi-generational home renovation tax credit. This tax credit gives you the lesser of $50,000 or 15% of the value you create if you create a secondary unit for a qualifying individual defined as someone who is 65 years or older in age, or someone 18 years or older with a disability, or a relative of a qualifying individual. There is more to it, and you can find out more details on the CRA website if you're interested in this. Now, another thing that very few of our clients are thinking about these days is to buy land now first, because they are at a discount with high interest rates, rent it out in order to hang on to it in the meantime, and then build later once the cost of capital lowers. But there is realistically risk involved with this strategy too. First off, cash flows might not be as strong if you rent out the property as a single family home temporarily, so you might find yourself needing to put in extra cash each month to cover any negative cash flows, which could be tough over time. Another thing is that once the house is rented out, you'll also have some risk here. If you want them to vacate to renovate later down the road, you would have to provide an N13 notice to the tenant 4 months in advance, and the tenant might even delay the move out process as well. You'll also have to compensate them with 1 month's rent. And if you're only going to be doing cosmetic renovations, your existing tenant would have the right to move back in as well. So that's something to keep in mind. From our experience, waiting to start a project just makes things more complicated, and that's why we do recommend diving right into the project after you buy. And if you do want to see how actual numbers and returns for these kind of projects look like, you've stumbled upon the right team. Every week, our team comes together to search and share the top investment projects in Toronto, so just reach out to us. We're not your typical real estate sales brokerage. Instead, we focus on using numbers to make better real estate investing decisions in Toronto. And that can mean looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns like value add renovations and gentrifying areas. If you do want to discuss your private real estate situation with us, just head over to this link here to set up a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.